Welcome back to the deep dive. Today, we're taking a fresh look at certificates of deposit, CDs.
Hmm.
Forget everything you think you know. They often get dismissed, right? Like, oh, that's just for super conservative folks.
Yeah, seen as a bit old-fashioned sometimes.
Exactly. But our deep dive today, looking into your sources, well, it reveals a surprisingly dynamic tool. If you use it right, it can actually be a bit of a game changer for, savvy savers.
It really can.
So we're going to challenge some myths, find maybe some hidden opportunities, and really try to help you leverage CDs beyond just the basics.
Now, what's truly fascinating here, I think, and often gets missed, is that in today's, complex financial world,
Yeah.
CDs offer this kind of unique mix, security and predictable growth.
Yeah.
But understanding when to use them and how, strategically,
That's the key.
that's where the real insight is. It's not just about grabbing a fixed rate. It's about making a really informed trade-off, one that actually lines up with your specific goals, your risk tolerance.
Absolutely. So let's pull back the curtain then. What exactly is a certificate of deposit, like at its core?
Think of it like this. You're putting money in a vault, a really secure one,
Okay.
but there's a timer on it. You commit to leaving a certain amount that's your principal locked away for a set time. We call that the term.
Right, the term length.
And in return for you doing that, for your patience, the bank promises you a fixed interest rate. Usually you'll see it as APY, annual percentage yield.
Got it. So it's a deal. Your patience for their guaranteed return. Simple.
It's a simple contract, yeah. And if we kind of step back, look at the big picture of personal finance.
Mm-hmm.
That core idea of a CD, it just boils down to a direct exchange. You're getting a higher interest rate generally than you would in a basic savings account.
Especially for longer terms, right?
Especially for longer terms, yeah. And this is critical, you're trading off immediate liquidity, access to your money.
Right. You can't just dip in whenever.
Exactly. And that distinction is just paramount. It means a CD isn't just another place to stash cash. It's a deliberate strategic choice. You really need to understand your future cash flow needs before you jump in.
Okay, so that's the core concept. Makes sense. Let's get into the mechanics then. How does this actually work? How does it turn from an idea into, something growing your money?
Right. So first step, you choose a term length. And this is a big decision.
How long are we talking?
Well, terms can be really short, like 3 months, or they can go all the way out to 5, sometimes even 10 years, though those are less common,
Okay.
the popular ones. Usually around 6 months, maybe a year, 5 years are pretty standard too.
So you pick your term, then what?
Then you deposit your principal. That's the initial lump sum you're committing.
Okay.
And the bank promises you that fixed APY, the annual percentage yield we mentioned.
Right, the APY. And that includes compounding?
Usually, yes. And that's important. APY isn't just the simple interest rate. It reflects the total return you get over the year, including the effect of compounding.
So your interest starts earning its own interest.
Exactly. Which can give your money a little extra push, especially over time. It might compound monthly, sometimes even daily.
So like a 12-month CD at 4% APY, you'd earn that 4% over the year with that compounding baked in.
Precisely. Now, generally speaking, longer terms often mean higher rates. But
There's always a but.
there is. It's not a hard and fast rule. It really depends heavily on the economic climate at the time.
Like what the Fed is doing, inflation.
Exactly. Federal Reserve policies, inflation expectations, even just how much banks are competing for deposits. All that plays into the rates they offer.
Okay, so here's where it gets really interesting for your money. Why pick a CD? Why not just stick it in a high-yield savings account, which, gives you more flexibility?
Well, the headline appeal is pretty clear.
Yeah.
You generally get higher rates for accepting less flexibility.
Higher rates. How much higher are we talking?
Our sources show that CD rates are almost always higher than standard savings accounts, often significantly higher than money market accounts, too.
It's like double, triple.
Sometimes, yeah. It's common to see the top CDs paying 3, maybe even 4 times the national average savings rate.
Wow, okay. That's a real difference.
It really is. It can seriously boost your returns. And there's another powerful plus,
Which is?
locking in that rate.
The fixed rate aspect.
Right. Think about it. If interest rates generally start to fall after you open your CD,
You're protected.
You're guaranteed that promised APY right up until the CD matures. Unlike a high-yield savings account, where the rate can float up or down anytime.
So that fixed rate shields you from rate drops. That's a nice bit of security.
It is. And speaking of security, this brings up a really important question for savers. How safe is my actual money in a CD?
Right, beyond just the rate. Is the principal safe?
And the answer here is, well, it's incredibly reassuring.
How so?
CDs at banks insured by the FDIC or credit unions insured by the NCUA, your funds are protected up to $250,000.
Per depositor, per institution, right?
Per depositor, per institution, in each ownership category. It's the same solid protection you get with a regular savings account.
So the federal government basically backs it up?
Exactly. Even if the bank were to fail, which is rare, your insured deposits are safe. It provides just unparalleled peace of mind.
So they're considered one of the safest investments then?
Absolutely. There's virtually no market risk. Your CD's value doesn't swing up and down with the stock market or economic news as long as you hold it until it matures.
Okay. So it's a genuinely low-risk, conservative option. Good for maybe stabilizing things if other investments are volatile.
Precisely. Our deep dive even found some cases where things like CD ladders actually offered better risk-adjusted returns than some short-term bond funds. Less volatility, competitive return for that safer part of your savings.
Okay, that certainty, that safety, it sounds incredibly appealing, but there's always a catch, right? What's the downside?
Well, as our sources clearly warn, like you said, there's a flip side. Every financial superhero has its kryptonite.
Right.
And for CDs, that Achilles heel really shows up if you need your money before the term is up.
Ah, the early withdrawal penalty.
That's the one. It's the biggest limitation. If you need to pull your money out before the CD matures, you will almost certainly pay a penalty.
And how bad are these penalties?
Well, it varies. Depends on the bank, depends on the CD term. Often, it's set as a certain number of months worth of interest.
Like 3 months interest for a 1-year CD, maybe?
Something like that, yeah. Or maybe 6 months interest or even more for a longer 5-year CD.
Okay, but what if you haven't earned much interest yet? Like if you withdraw really early?
That's the crucial warning our sources highlight.
Hmm.
In a worst-case scenario, say you pull out very early or it's a very short-term CD, the penalty could actually be more than the interest you've earned.
Meaning it could eat into your original principal.
It could. Imagine you put in $10,000. You only earned $50 in interest, but the penalty is $100. You'd actually get back $9,950. You'd lose $50 of your initial investment.
Ouch. Okay, I actually had a friend, they thought they could just sort of pause their CD for a quick purchase, learned about penalties the hard way.
Yeah, it happens. It really highlights the commitment involved.
It really does. So it's not just the penalty amount itself.
No,
It's
absolutely not. It's also about what we call opportunity cost.
Meaning?
Meaning, think about why you might need that money early. Your car breaks down suddenly, needs big repairs. Or maybe an amazing, truly once-in-a-lifetime investment opportunity pops up that needs cash now.
Ah, okay.
If your money is locked up in that CD, the cost isn't just the interest penalty you pay, it's the opportunity you missed because your capital wasn't flexible.
Right. That could be even bigger than the penalty.
It could.
Yeah.
And our sources stress that overlooking this opportunity cost can be just as damaging as ignoring the penalty formula.
Yeah.
It means you really have to think hard about your potential need for funds. Not just plan stuff, but life's curveballs too.
So you need a solid emergency fund outside of CDs.
Absolutely. Now, there are options like no penalty CDs. They let you withdraw early without a fee.
Okay, that sounds useful. What's the catch there?
The catch is they almost always offer lower interest rates. You're paying for that flexibility with a lower yield. So, again, it's a trade-off. Peace of mind on liquidity, but less earning power.
Okay, so weighing all this, what does it mean for you, the listener? When are CDs actually a smart move? When should you maybe, look elsewhere?
Well, CDs are incredibly useful when you have a specific sum of money, and you're pretty darn sure you won't need it for a specific period. And during that time, you want a guaranteed return that's better than a basic savings account.
Like saving for a goal with a deadline.
Exactly.
Yeah.
Let's say our listener, Alex, is saving for something big in 3 years. Maybe a down payment on a car, maybe a home renovation project.
Okay.
A 36-month CD could be perfect. Lock in a potentially good rate for that exact time frame. Guaranteed growth, no market stress about that particular chunk of money.
And you mentioned timing with interest rates.
Right. CDs can be really good if you think interest rates might fall. You lock in today's higher rate and protect yourself against those drops for the whole term.
But the flip side, if rates go up.
Exactly. If you think rates are likely to rise, locking into a long-term CD means you miss out on those potentially higher future rates. That's the rate rise risk.
So in a rising rate environment, maybe shorter CDs,
Yeah,
or just a high yield savings account for flexibility.
that could be smarter, yes. Keep it short, keep it flexible so you can reposition your money to capture better yields later. It's a nuanced calculation. Locking in protects from drops, but prevents gains from rises.
That makes sense. You mentioned earlier something about addressing the liquidity concern, CD laddering.
Ah, yes. If we look at smart saving strategies, CD laddering is a really popular way to handle that liquidity issue while still trying to capture those better long-term rates.
Okay, how does laddering work? Break it down for us.
It sounds complex, but it's pretty straightforward. Instead of putting, say, $10,000 into one single 5-year CD, you split it up. You might put $2,000 into a 1-year CD, $2,000 into a 2-year, $2,000 into a 3-year, and so on, up to 5 years.
Ah, okay, so you have multiple CDs with different end dates, staggered maturities.
Exactly. Staggered maturities. And the huge benefit is this. Every single year, one of those $2,000 CDs matures. It comes due.
Giving you access to some cash each year?
Precisely. It gives you liquidity. You can take that matured money and use it if you need it. Or if you don't need it,
Reinvest it.
you can reinvest it, maybe into a new 5-year CD at the end of the ladder, potentially at current, maybe higher rates. Meanwhile, the rest of your money in the longer-term CDs is still earning those higher rates.
So it balances liquidity needs with potentially higher yields, creates a kind of regular cash flow from your CDs.
It does. And you don't have to do a 5-year ladder. You could build a shorter one, maybe a 12-month ladder with CDs maturing every 3 months if your potential cash needs are sooner.
That's actually a really powerful strategy. It makes CDs seem much more flexible.
It does. And laddering isn't the only trick. Our sources also pointed out a few other types of CDs worth knowing about.
Oh, yeah. Like what?
Well, there are things called bump-up CDs. These sometimes let you request a rate increase if prevailing interest rates go up during your term.
Oh, interesting. So some protection against rising rates?
A little bit, yeah. Usually you only get one chance to bump up, but it's something. Then you have liquid CDs, or sometimes called flex CDs.
Like the no penalty ones?
Similar, but maybe slightly different rules. They might allow, say, one penalty-free withdrawal during the term, maybe after an initial waiting period. Again, likely a lower rate for that privilege.
Okay. Any others?
There are also brokered CDs. These you buy through a brokerage firm, not directly from a bank.
Why would you do that?
Sometimes they offer slightly higher rates, and importantly, there might be a secondary market for them, meaning you could potentially sell the CD to another investor before maturity, possibly avoiding bank penalties, though you might sell at a loss or gain, depending on current rates. Adds complexity, but potentially more liquidity options.
Wow. Okay, so the simple CD isn't quite so simple. There are variations.
Exactly. The basic concept is simple, but there are these different flavors. It shows the humble CD isn't nearly as rigid as people might think. It can be quite a dynamic tool if you know the options.
So really it comes down to understanding the tool and your own needs.
Absolutely. A CD is a tool. And like any tool, how effective it is depends entirely on if you understand its strengths, its weaknesses, and crucially, your specific situation.
Right. For Alex, saving for that car in 3 years, maybe the plain vanilla 3-year CD is perfect.
Could be. But if Alex thought they might need smaller amounts, maybe once a year during that time, a ladder might be far better. Or maybe a liquid CD.
So understanding these options and keeping an eye on the economy and rates, that really elevates your savings game.
It really does. This isn't just about, locking money away passively. It's about actively choosing the right way to position it for predictable growth, given your own life circumstances.
Wow. Okay, that was genuinely a deep dive. I have to say, I'm surprised by how versatile CDs can be when you dig into it, especially laddering and knowing about bump ups or liquid options. It really makes you rethink what a safe investment means and how you can use it strategically in your overall financial picture.
Yeah.
So to quickly summarize then, a CD is basically a time-bound deposit.
Right.
Fixed interest rate, great for guaranteed returns if you know you won't need that money short term.
Right.
They almost always beat standard savings rates, often by a lot, and they're super safe thanks to that FDIC or NCUA insurance.
Very safe.
But the trade-off, the big one, is liquidity. You sacrifice easy access and those early withdrawal penalties. They can hurt, potentially even biting into your principal.
Definitely need to check those rules.
Absolutely. Check the penalty rules before you commit. So use them for specific goals, maybe lock in rates when you think they'll fall, but understand that commitment.
And just to reiterate,
Yeah.
please don't put your entire emergency fund in a CD.
Right.
Good point. Keep that emergency cash somewhere instantly accessible, liquid.
Absolutely. But for funds, you genuinely can park for a while.
Hmm.
Where you really value capital preservation and getting a predictable return, CDs can be a really valuable, conservative, secure part of your overall saving strategy.
That predictability seems key, an anchor in the portfolio.
It provides an anchor, yeah. Predictable growth that, more volatile investments just can't promise. It's a crucial piece for a well-rounded plan.
Well, hopefully you've just gained a much clearer, more nuanced understanding of certificates of deposit, from the basics of how they work to when they might be really beneficial, and even some strategies like laddering. We hope this deep dive gives you the confidence to consider them, where they truly fit in your own financial planning. Yeah, and maybe this leaves you with an important question to consider. When you're planning your savings, how do you personally weigh that certainty, that guaranteed fixed return, against the need for flexibility, for immediate access? Thinking not just about the penalty cash, but that opportunity cost too. It's a balance, isn't it? And it's unique to your circumstances and probably changes as your life changes.
That is a powerful thought to mull over as you build and refine your own strategy. Until next time on the deep dive, keep exploring, keep learning, and keep making those informed decisions.